Welcome to Tax Smarts Unlocked, the podcast for individuals and small business owners looking to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services, each episode is packed with insightful advice on proactive tax planning to help you navigate the complexities of tax laws. Here's your host, David Robson.
Welcome to Tax Smarts Unlocked. I'm David Robson, your resident tax strategist and translator of IRS ESE. Today we're unpacking remote employee incentives that actually boost morale without bloating your tax bill. Incentives matter more in distributed teams because culture has to travel through screens and dollars. The twist is that structure determines taxation. The same $100 can be fully taxable wages or a tax-free fringe with payroll tax savings on both sides. My goal: give you practical, compliant designs you can implement this quarter with documentation tips you'll thank yourself for later. Let's start with the Swiss Army knife of remote incentives, an accountable plan. Under IRS rules, if you reimburse ordinary and necessary business expenses with substantiation, those payments are not taxable wages and aren't subject to payroll taxes. The plan needs three pillars: business connection, timely substantiation, and return of excess. Put it in writing, define categories you'll reimburse, set deadlines for receipts or per diem logs, and run payments outside W-2 wages. Do that, and you've converted stipends into tax-smart reimbursements. Common remote expenses fit nicely: internet, a business mobile line, and ergonomic equipment. Treated correctly, these can be working condition fringes, costs an employee could deduct if paid personally. Adopt a policy: reasonable work use percentage for home internet, proof of business use for phone, and pre-approval for equipment like chairs, monitors, and webcams. Reimburse actual costs or issue company-owned gear. Keep itemized receipts and a brief business use statement. Skip flat allowances without proof. They usually turn everything into taxable wages. Cash is king, but for taxes, it wears a crown of thorns. Cash, gift cards, and most flat stipends are taxable compensation, always. If morale is the goal, consider tax-favored alternatives first. Reimburse expenses under your accountable plan, offer company-paid equipment, or provide qualified fringe benefits we'll cover next. When you must use cash, be intentional. Gross up for taxes so employees actually feel the value, and time bonuses to coordinate with benefit elections. And never label a payment a stipend and assume it's tax-free. It isn't. De minimis fringes are the tiny but mighty category. Low value, infrequent perks like occasional snacks, company swag, or a modest holiday gift, not cash or gift cards. Keep amounts small and frequency occasional, and they're tax-free and simple. Employee achievement awards are different. Tangible personal property for length of service or safety awards, within limits. Generally, think up to $400 per employee, or up to $1,600 under a qualified plan award with a written program. No cash, gift cards, vacations, tickets, or securities. Document criteria, recipients, and value. Yes, you can throw a remote party and keep it tax efficient. Company-wide recreational events for employees, think virtual holiday parties with shipped kits, can be 100% deductible if primarily for rank-and-file staff. Be careful with meal delivery gift cards. Cash equivalents are taxable to employees. Instead, consider catering shipped to homes billed directly to the company with attendee lists and an agenda. For business meals, deduction is generally 50% today. Note who attended, the purpose, date, and amounts. Documentation turns memories into deductions. Education incentives are morale gold and tax-friendly. Under Section 127, you can provide up to $5,250 per employee per year for tuition, fees, books, and through 2025, under current law, student loan repayment. Verify the current year status before launching. Payments are excluded from wages and payroll taxes when you adopt a simple written program. Separately, job-related education can qualify as a working condition fringe if it maintains or improves skills and doesn't qualify the employee for a new trade. Coordinate these paths and avoid double counting the same expense. Health benefits still anchor total rewards, even for remote teams. Options range from group health plans to ICHRAs reimbursing individual policies by class to QSRAs for eligible small employers. Pair HSA-eligible plans with employer HSA contributions for triple tax advantages. EAPs can be accepted benefits covering counseling, legal, and financial resources. Beware general wellness stipends or gym reimbursements without substantiation. They're usually taxable wages. If wellness is a priority, build structured programs with documented participation, or reimburse actual expenses under your accountable plan where a clear business connection exists. Family-focused incentives resonate in a remote world. Dependent care assistance plans under Section 129 allow up to $5,000 per year, $2,500 if married filing separately, excluded from wages to help with daycare and after-school care. Adoption assistance can be provided tax-advantaged, subject to annual limits and income phase-outs, great for inclusivity. Group term life insurance under Section 79 is excludable up to $50,000 of coverage. Amounts above that create imputed income your payroll system must track. Communicate clearly so employees understand value, limits, and any impact on taxable income throughout the year. Retirement benefits are still the heavyweight incentive for retention. A 401k with a predictable match signals long-term commitment. Safe harbor designs remove most non-discrimination testing headaches and ensure rank-and-file employees benefit. Add discretionary profit sharing to reward company performance, potentially using new comparability allocations if appropriate. Coordinate bonuses with deferrals. Announce bonuses early so employees can increase pre-tax or Roth contributions within limits before year-end payrolls run. And don't forget employer contributions. Reduce payroll taxes compared to equivalent cash, stretching your budget while delivering a benefit employees value. And remember, equity can be powerful for remote talent, but tax mechanics matter. ISOs offer potential long-term capital gains and no payroll taxes, but watch AMT and holding periods. NSOs trigger ordinary income at exercise on the spread and require withholding. RSUs are taxed at vesting as wages. Consider sell-to-cover mechanics. For early-stage companies, 83B elections on restricted stock can lock in low ordinary income now and convert future growth to capital gains if filed within 30 days. Section 83I, deferral is niche and compliance heavy. Educate employees and avoid surprise tax bills. Travel rules hinge on the employee's tax home, the main place of business. For fully remote staff whose home is the principal workplace, trips to headquarters are business travel if the assignment is temporary. Reimburse under your accountable plan using actuals or IRS per diem rates, including high-low substantiation. Keep contemporaneous logs, dates, locations, purpose, and receipts where required. If an employee relocates and the arrangement is indefinite, the travel may become taxable commuting. Clarify expectations in offer letters and travel policies so status aligns with tax treatment. Remote teams trigger multi-state obligations quickly. You may need to register for payroll withholding and unemployment insurance in the employee's work state, follow that state's wage laws, and possibly pay disability or local payroll taxes. A single remote employee can create income tax nexus, requiring returns and sometimes business licenses. Some states apply convenience of the employer sourcing rules. New York and Delaware are well known, so wages may be taxed where the employer sits even when work occurs elsewhere. Map your footprint and build a compliant payroll matrix. Many tax-favored benefits come with non-discrimination strings attached. Health plans, cafeteria plans, dependent care, adoption assistance, and educational assistance can lose their tax advantages if benefits disproportionately favor owners or highly compensated employees. Retirement plans have rigorous testing and top-heavy rules unless you adopt safe harbor designs. For HRAs, define employee classes carefully and apply terms uniformly. Document eligibility, waiting periods, and employer contributions in written policies, and test annually. A quick review with your benefits advisor can preserve exclusions you're counting on and avoid embarrassing Form W-2 corrections. Common mistakes I see. Tech stipends paid monthly with no receipts, fully taxable and payroll taxed. Gift cards handed out as prizes and treated as tax-free. Sorry, they're wages. Buying fancy chairs personally and reimbursing months later without substantiation. Taxable. Weak documentation for meals and events. Deductions lost. Missed Form W-2 codes. Box 12 Code DD for employer health coverage reporting. Code W for HSA contributions. Code C for group term life imputed income. Code T for adoption benefits. Fixing this retroactively costs time, money, and goodwill. Build processes that make compliance automatic. Case Study 1. A 25-person startup paid $200 monthly remote stipends, $5,000 in ad hoc wellness cash, and offered no health or education benefits. Every dollar hit payroll and income taxes. We implemented an accountable plan and converted the stipend into reimbursements for internet, mobile, and ergonomic gear with receipts, about $150 average per month, tax-free. We added a QSIHRA of $3,000 single $6,000 family and a Section 127 plan funding up to $2,000 per employee for job-related courses. Result, higher perceived value, 7.65% FICA savings on reimbursements, and dollars shifted from taxable perks to exclusions. Case Study 2. Instead of $1,000 taxable year-end bonuses, a client added a 3% safe harbor match, gave tangible achievement awards under a qualified plan, and sprinkled de minimis perks. Payroll taxes fell, deductions improved, and engagement scores climbed, without increasing total spend. Action checklist. Audit perks, adopt an accountable plan, pick 2 or 3 tax-efficient benefits, update handbook and payroll codes, then review annually with your tax and benefits advisors. Thanks for listening to Tax Smarts Unlocked. We covered accountable plans, tax-favored fringes, education, health, family, retirement, equity, travel, and multi-state traps, plus 2 case studies. When in doubt, call a pro. Smart Structure turns the same dollars into happier teams and better retention.
Thank you for joining us on Tax Smarts Unlocked, the ultimate podcast for individuals and small business owners ready to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services, each episode has been carefully crafted to provide you with insightful advice on proactive tax planning. By adopting a smarter tax approach, you can focus on what you do best, growing your wealth and your business. We're here to guide you every step of the way. Don't miss an episode. Subscribe to Tax Smarts Unlocked on your favorite podcast platform and unlock the secrets to confident tax planning. Remember, it's time to take control of your taxes and unleash your full financial potential.